There's a powerful idea that has shaped how many approach the financial markets. It's called the efficient market hypothesis, or EMH. It's an elegant concept suggesting that all known information is already baked into the price of an asset. Stocks, bonds, everything. The implication is profound. If markets are truly efficient, then consistently beating them is an exercise in futility. For many, this leads straight to the embrace of passive investing, a seemingly rational response to an unassailable truth. But what if this pillar of modern finance, as elegant as it is, actually harbors critical flaws? What if these flaws leave ambitious investors vulnerable? And more importantly, what if they create fertile ground for the truly discerning eye, the critical mind? Benjamin Graham, the father of value investing, offered a timeless perspective when he said, "The stock market is a voting machine in the short run, but a weighing machine in the long run. We often get so caught up in the immediate vote, the daily fluctuations, the herd mentality, that we forget to engage with the deeper, more fundamental weight of an asset. The perceived efficiency of the market can sometimes be a mirage, obscuring the real substance beneath." In this journey, we will go beyond the surface. We will dissect for fundamental truths about the efficient market hypothesis that are often overlooked in mainstream interpretations. Our aim is not to dismiss the theory entirely, but to equip you with a more critical, data-driven lens. We will uncover what lies beyond the bell curve, revealing why a deep understanding of EMH's limitations might just be your biggest advantage in navigating the markets and building sustainable wealth. This is your guide to becoming a truly critical investor. The efficient market hypothesis rests on a fundamental assumption that market participants are perfectly rational actors. They are envisioned as processing all available information with cold, objective logic, making decisions that instantly and accurately reflect an asset's true value. If this were consistently true, then any deviation from fair value would be a fleeting anomaly, immediately corrected. However, the landscape of human behavior is far from this idealized rationality. Behavioral finance has illuminated the pervasive influence of psychological biases that profoundly impact our financial decisions. Think of confirmation bias, where we seek out information that validates our pre-existing beliefs, or loss aversion, the powerful tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain. And then there's herd mentality, the primal urge to follow the crowd, even when the crowd is demonstrably wrong. History is replete with examples, from the speculative frenzy of tulip mania to the dot-com bubble, where collective irrationality led to dramatic mispricings. These psychological forces don't just cause occasional blips, they create persistent inefficiencies. If markets were truly efficient, these predictable patterns of irrationality would be instantly exploited for profit. Yet, time and again, we see these biases lead to markets that are anything but efficient. The myth of the purely rational actor crumbles under the weight of human nature. So, what is the practical takeaway for us, the critical investor? It begins with introspection. We must acknowledge and understand our own behavioral biases. Keeping an investment journal, documenting not just the decision, but the emotional state at the time of analysis, can be a powerful tool. This practice helps us identify patterns of irrationality within ourselves, allowing us to preemptively address them before they inflict damage on our portfolios. The efficient market hypothesis envisions a perfectly calibrated thermometer, but the reality is that the market is often swayed by the unpredictable winds of human emotion. Our task is not merely to read the temperature, but to learn to read those winds and navigate accordingly. The efficient market hypothesis, in its purest form, posits a world where all relevant information is instantly and equally available to every single market participant. Imagine a perfectly clear lake where every pebble on the bottom is visible to all. This idealized state suggests that no one can gain an advantage simply by knowing more or by being quicker to access information. However, the reality of the financial world is far more complex and often far murkier. This is the realm of information asymmetry. Insiders at companies, large institutional funds with dedicated research teams, and even diligent independent investors who commit to deep dive analysis can, and often do, possess superior or earlier access to crucial data. This isn't about illegal insider trading, but about the natural advantage that comes from dedicated effort, specialized knowledge, and established networks. These information gaps, especially concerning intricate financial instruments, nascent industries, or subtle shifts in competitive landscapes, create pockets of inefficiency. These are not fleeting moments, but sustained opportunities for those who are willing to put in the work to uncover them. The perfectly clear lake of EMH gives way to a reality with hidden currents and submerged treasures, accessible only through careful, dedicated probing. For us, the critical investor, the actionable insight lies in developing a framework for seeking this edge information. It means looking beyond the headlines and the consensus. It involves a commitment to deep fundamental analysis, poring over industry reports, understanding the true incentives of company management, judgment and connecting dots that others might miss. By actively seeking out and diligently analyzing information that isn't readily broadcast, we can begin to navigate the murkier waters and discover the true value that the market, in its perceived efficiency, may have overlooked. The efficient market hypothesis hinges on a crucial mechanism: arbitrage. The theory suggests that if any asset is mispriced, too low or too high relative to its intrinsic value, a legion of opportunistic arbitrageurs will instantly descend. They will buy the undervalued asset and sell the overvalued one, their collective actions swiftly correcting the market and restoring equilibrium. EMH paints a picture of a perfectly efficient cleanup crew, constantly tidying the market. But in the real world, this cleanup crew is often far from perfect. Arbitrage, while a powerful force, faces significant practical constraints. Consider the sheer amount of capital required to make a meaningful impact on large markets. Then there are transaction costs, the fees, the bid-ask spreads that eat into potential profits. Regulatory hurdles can further complicate matters, and perhaps most importantly, there's the inherent risk. A perceived mispricing might, in fact, worsen before it corrects, leading to substantial losses for those betting on an immediate reversion to the mean. These limitations mean that mispricings can, and do, persist for far longer than the idealized EMH would predict. This is particularly true in less liquid markets, where fewer participants mean fewer arbitrageurs, or for complex, less transparent assets where identifying true value is a more arduous task. The geniuses of arbitrage are not always able to act, or their actions are not swift enough to instantly erase all discrepancies. For the critical investor, this truth offers a vital pathway. Instead of seeking fleeting arbitrage opportunities, we should focus on identifying mispricings that offer a substantial margin of safety. This concept, championed by Benjamin Graham, means buying assets at a price significantly below their estimated intrinsic value. This buffer allows our investment to withstand temporary adverse price movements and the inevitable transaction costs, providing the space for the market's eventual, albeit not always instantaneous, correction. We learn to recognize that the cleanup crew is often understaffed and that patience, coupled with a deep understanding of value, is a far more reliable strategy. The efficient market hypothesis, despite its theoretical elegance, faces a persistent challenge from what are known as market anomalies. These are observable, persistent patterns in asset returns that seem to defy the hypothesis's core tenet, that all available information is already factored into prices. Anomalies like the value premium, where value stocks historically outperform growth stocks, or the size premium, where smaller companies tend to deliver higher returns, poke holes in the idea of perfect market efficiency. Academic studies and empirical data provide compelling evidence for these phenomena. Year after year, diligent researchers have documented how certain factors consistently predict higher returns, directly contradicting the notion that markets are so efficient that no such predictable patterns should exist. These aren't mere statistical quirks or random noise. They often reflect deeper, systemic issues that EMH struggles to reconcile. They can point to overlooked risk premia that investors demand for bearing certain types of risk, persistent behavioral biases that lead to systematic mispricing, or fundamental structural characteristics of the market that EMH, in its abstract formulation, simply overlooks. Think of EMH as a general who believes every soldier in his army follows orders with perfect discipline. Market anomalies are the rogue soldiers, consistently deviating from the plan. Their predictable deviations reveal that the army's discipline, and by extension, the market's efficiency, is not as absolute as the general believes. For us, the critical investor, this offers a powerful actionable insight. Instead of blindly accepting the premise of perfect efficiency, we can learn to identify these anomalies. By understanding the underlying reasons for their existence, we can develop strategies that systematically aim to capture these premiums. This moves us beyond a purely passive approach, allowing us to build a more informed and potentially more rewarding investment strategy, one that acknowledges the persistent deviations from the idealized efficient market. We've journeyed through for fundamental truths that challenge the simplistic narrative of the efficient market hypothesis. We've seen how human psychology, information asymmetry, the practical limits of arbitrage, and persistent market anomalies reveal that markets are far from perfectly efficient. These aren't just academic debates, they are the very cracks through which genuine investment opportunities can be found. So, how do we equip ourselves for this more nuanced reality? The Critical Investor's Toolkit is built on a foundation of deep fundamental analysis, a keen awareness of behavioral finance, and, crucially, a healthy dose of skepticism. It's about understanding the why behind price movements, not just the what. This approach moves beyond the binary choice of passive versus active investing. Instead, it calls for a critical strategy, actively seeking out and understanding market inefficiencies, while simultaneously respecting the powerful forces that do drive market behavior. It's not about chasing fads or blindly following following the consensus, but about cultivating an independent, data-driven perspective. Let's outline a simple, actionable framework. First, always question the MH assumptions in specific contexts. Is this market truly efficient today for this particular asset? Second, actively seek behavioral and informational edges. Dedicate yourself to understanding the human element and to uncovering data that others might overlook. Third, build a robust, resilient portfolio. This means constructing a portfolio that acknowledges known anomalies and accounts for inherent risks rather than assuming they don't exist. The market is not a perfect, self-regulating machine. It is a complex, dynamic ecosystem full of imperfections and, indeed, opportunities. By understanding these imperfections, you can transition from being a passive passenger, simply along for the ride, to becoming a critical navigator. You can chart a more informed, more resilient course towards sustainable wealth creation. We've journeyed together, moving beyond the elegant, yet often misleading, surface of market efficiency. We've uncovered for critical truths that challenge the very foundations of the efficient market hypothesis. We've seen that markets are not populated solely by perfectly rational actors, that information is rarely perfectly symmetrical or instantly disseminated, that arbitrage is constrained by reality, and that persistent anomalies offer undeniable evidence of imperfection. The core takeaway from our exploration is profound. The market is not a flawless, self-correcting mechanism. It is a complex, often unruly arena shaped by human psychology, information gaps, and structural realities. These imperfections are not merely statistical noise. They represent both significant risks to the unwary and invaluable opportunities for the discerning. This understanding is not about fostering cynicism, but about cultivating empowerment through critical thinking. By acknowledging these truths, you are now better equipped to question conventional wisdom, to analyze financial data with a more discerning and skeptical eye, and ultimately, to make more informed, data-driven decisions. It's about moving from passive acceptance to active, intelligent inquiry. Warren Buffett, a figure synonymous with investment mastery, once advised, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This wisdom extends beyond individual stocks to the very information we consume about markets. The fair price of market information itself is rarely as efficient or as complete as proclaimed. The real value lies in understanding the nuances, the hidden costs, and the potential for mispricing. Therefore, I urge you to continue this journey of critical inquiry. Take these principles and apply them rigorously to your own investment analysis. Remember that true mastery in investing, just as in any discipline, lies not in passively accepting established theories, but in rigorously testing them against the unvarnished reality of the markets. Continue to question, continue to learn, and continue to build your own unique edge.